It's good. No, actually, not even close. Not even one bit. We got a long ways to go. Long ways to go. Instead of doing my practical skill module that's required to do in the next few days, instead of doing all that, well, I can do some financial modeling instead. I'm gonna just use the bot that I put together. I didn't code shit, but it's not financial advice. So like, why would you listen to me? These are just like hypotheticals, but like, American dream, American dream. I'm back with another to the backdrop here, economic or market cycle. This is to see where we are for an expansion. What kind of asset allocation would probably make more sense, but I'm not an advisor, not financial advice, but just hypotheticals here that we're looking at that the parameters I'm not really going to get too deep into. Doesn't make any sense because it would just take a lot of explaining, but it's in my Discord. We can see the GDP growth is still there. Steady, healthy expansion at 1.6%. When we look at unemployment, unfortunately, a lot of people can't get jobs, especially with the AI auto rejections, but there's jobs out there to be had, but the pay just doesn't quite match what these people are expecting. So, unemployment rate, you can see we're kind of back to the basics, back to where you might want to be in an expanded economy. Yield curve, back to normal, no recessional or recession signals on that side. Risk appetite is still there for credit spreads, but one thing is going to be really sticky is going to be inflation. Still hot, but cools here month over month, depending on what sector or what you're including in that. The Feds are not going to go back to that 2%. It is what it is. It just doesn't make sense. And cutting rates that fast, that quick, would just be a disastrous thing. But we don't, I don't see that happening. So we will see. So putting those things together, right, those core factors, you can see us being in that mid expansion. And what that means, the economy is running hot, but it's not overheating. Corporate earnings, especially the last few, some of them are really strong with guidance being either maintained or improved. Just a few different sectors, maybe tech. Some AI companies may have to change their guidance a little bit, but nothing that's going to be a major impact on the balance sheet here. Credit is still flowing and risk assets are outperforming. So historically, this is where you can see capital expenditure ramping up, commodity strengthening, cyclicals outperforming defensive stocks, and you can see that value rotation start to accelerate, meaning that this is where you can see real growth and real economic activity start to happen. But when we're looking at what sectors to potentially be overweight or underweight at, as you can see, industrials, you can see global growth happening there. Materials, commodity demand might get a little bit stronger. Energy demand growth, high inflation might be a benefit to those companies, passing off those prices to the consumer. I feel that, especially with electricity. Hot as shit down here in Florida. Earnings been pretty strong for a lot of these tech companies and financials. Right now we're looking at the IPOs, mergers and acquisition activities, credit growth, thing of that nature. But where we could find better opportunities, if it's not in utilities, real estate, or consumer staples, there's going to be better growth opportunities and more attractive opportunities outside of utilities. Real estate, you can see the rates are going to be headwinds. The real estate market's been very up and down. Consumer staples, with inflation, everything's become more expensive. So not necessarily a lot of opportunities for growth on the balance sheet for these companies in the long term. But quarter to date, or the last 3 months, tech has been ripping it, especially coming off early sell-off in the beginning of the year, and then basically another baby sell-off a few weeks ago. Financials are still finding ways to perform, put numbers up. Materials, as you go down, and you can start seeing energy had that high run earlier in the year, but now that oil, gas prices, somewhat coming down depending on what state you're in. A lot of reallocation because these companies can't continue to pass off the price to consumers without eventually having to shift back to normal prices. But you're looking at an improving environment here. Steady growth, inflation is sticky, but financial conditions are easing. That's really how I can put it. When we're looking at this, the S&P sitting about 7,500, give or take, you know, above the 50-day and 20-day moving averages for the technical guys. The 1 month barely flat here. 3 months, you can see back to all-time highs in a 1 year, about 25% a quarter. Momentum is still strong. Trends are still intact. Volatility is cooling down. As you can see, the VIX dropped from 22 to 16, give or take, just based on the recent sell-offs a few weeks ago, and then just right back up with basically buying everything that was sold off. People are feeling greedy as of what, 2 days ago today, give or take, but sentiment is still neutral. Some of the insider stuff I'm not going to get into because that's just more work for me. The sector rotation on a 1 month, technology is leading the way once again. Industrial is still trying to keep up and push pace with financials right behind them, materials, healthcare, real estate. But as you can tell, energy, big decline because everyone was taking gains. A lot of peace talk, peace treaty could have an impact on oil prices and things of that nature. But I'm not going to get too deep into the politics and macro risk here, but something to look at in the long term. But to the big deal here, we'll be looking at short term, medium, and long term, right? 1 to 3 months. The short term really doesn't matter. There's volatility too much to just be like, hey, this is what's going to happen. But medium to long term, we're looking at a bullish, you know, forecast here where it makes more sense to be in equities rather than anything else, but personal preference.